Government revenue and spending. Principles of taxation. Economists use certain principles and criteria to evaluate whether or not taxes should be paid and who should pay them. The principles most often are based on the benefits taxpayers receive and their ability to pay. Criteria for taxation. The equity or fairness of a tax is established by how uniformly the tax is applied, requiring that people in similar situations pay a similar amount of tax. The simplicity of a tax is determined by how easy it is for taxpayers to understand, how easy it is for the government to collect. In addition, there should be no confusion about the time the tax is due and the amount to be paid. The efficiency of a tax can be judged by how well the tax achieves the goal of raising revenue for the government with the least cost in terms of administration. Tax bases. Individual income tax is a tax based on an individual's income from all sources: wages, interest, dividends, and tips. Corporate income tax is a tax based on a corporation's overall profits. Sales tax is a tax based on the value of a designated good or service at the time of sale. Generally, sales taxes are imposed on a wide range of goods and services. The tax is usually a percentage of the posted good or service and is included in the final price that the buyer pays. Property tax is a tax based on the value of an individual or business's assets, generally real estate. Homeowners and business owners pay property tax based on the value of their buildings and the land on which the buildings stand on. Tax structures. A proportional tax takes the same percentage of income from all taxpayers regardless of income level. A progressive tax places a higher percentage of taxation on higher income earners than lower income earners. A regressive tax takes a larger percentage of income from people with low income than from people with high income. Impact of taxes on the economy. Resource allocation. A tax placed on a good or service with the intent of the cost to increase the cost productions and therefore to shift the supply curve to the left. Productivity and growth. When taxes on interest and dividends are high, people tend to save less than when taxes on this source of income are low. Therefore, they have an impact of the amount of money available to invest in their businesses. Economic behavior. A tax used with incentives to encourage or discourage certain economic behaviors. By providing tax credit, or rebate, the government may encourage behaviors that it believes will be good for the economy and for society. Federal government spending. Federal expenditures. The federal government takes in a huge amount of money. The programs and services the federal government funds with this revenue are divided into categories. Mandatory spending. Spending that requires that by the current laws, mandatory spending makes up well over half of all federal spending. Most of the spending is in the form of entitlement, which are social welfare programs with specific Social Security and Medicaid, or entitlement programs that provide payments to anyone who is eligible based on age or disability. Discretionary spending that the government must authorize each year. More than 1/3 of federal revenue is devoted to discretionary spending. The federal, also military and education, makes up a big part. The federal budget and spending. Each year, the President and Congress work together to establish the federal budget, a plan of spending federal money. The budget for a fiscal year, a 12-month period for which an organization plans its expenditures. The federal government's fiscal year runs from October 1st through September 30th. The presidential budget is prepared by the Office of Management and Budget combined and takes into account the estimated tax receipts and requests by all federal departments. Congress acts on the budget. Methods of federal spending. After the budget is approved, the funds are spent over several years. One way is to direct spending, by which the government buys a good and services that is needed to operate. A second way the government spends the money is through transfer payments, money distributed to individuals who do not provide goods or services in return. A grant and aid is a transfer payment from federal government to a state or local government. The impact of federal spending. The federal government influences the economy in 3 different ways: resource allocation, income redistribution, and competition with private sectors, which is that part of the economy owned by individuals or businesses. State and local spending. The federal government has the broadest tax base, which is the smallest income tax base of local level. State ventures from a variety of sources, the largest of which is the government revenue, mostly grant and aid the federal government. States also raise funds from state sales and taxes from state income, both individuals on corporation. Type 1, sales and excise taxes. Type 2, income tax and other revenue sources. State budgets and spending. All states except Vermont are required to have a balanced budget in which the total government sources is equal to the total government spending. Balanced budgets. State budgets are actually work with two types of budgets. An operating budget, a plan for day-to-day expenses, and a capital budget is a plan for major expenses. State expenses is education is a major part. Also safety. Local revenue expenses go to cities, towns, and villages and other school districts. Property tax. This tax can be levied on certain situations, on personal property, motor vehicle, boats, or computers. Local government rely on tax ushers as government officials who other taxes. Local governments also use sales taxes to make their revenue.